The Paris Agreement suggests that $16.5 trillion is needed between now and 2030 if we are to decarbonise the world's economy and keep global warming well below 2 degrees Celsius. That's around $1.1 trillion per year. So, what progress are we making towards this goal? According to the Climate Policy Initiative, direct climate finance flows were estimated to be worth around $391 billion in 2014. Now, that's certainly a lot of money. However, we still have some way to go to meet the funding goal set in Paris. But what do we actually mean when we talk about direct climate finance? Broadly, direct climate finance can be defined as a type of economic instrument used to promote certain purchases, investments, or behaviours through financial incentives. Direct climate finance differs from market-based policies, such as carbon pricing schemes, in that it is used to directly fund projects that contribute to climate change mitigation or adaptation. Most of this funding comes in the form of conventional incentives such as grants, subsidies, low-interest loans or equity shareholding. Grants are sums of money given upfront by a government or other organisation to assist in covering initial capital costs of a project. Grants generally do not have to be paid back. Subsidies, on the other hand, are a sum of money given by the state or a public body to help an industry or business keep the price of a commodity or service low. Subsidies are commonly provided for energy consumption. For example, where the government provides a discount on the market price of diesel fuel for heavy vehicles operating in the mining sector. A low-interest loan is often referred to as a concessional or soft loan. These are provided on terms much more generous than what could be obtained from the market. In a nutshell, concessional loans are paid back, but the interest is relatively low. Other conventional forms of direct climate finance include equity shareholding. This is where a person or organisation provides upfront capital to fund the development of a low emissions project. In exchange, the investor gets a percentage ownership in the project and, therefore, any profits or capital appreciation that may be generated over its lifetime. Recently, more innovative direct climate finance incentives have been emerging and growing in importance. For instance, climate bonds. So, what is a bond, you may ask? In simple terms, a bond is a type of tradable loan that companies, governments and banks use to finance projects. Climate bonds are effectively the same as normal bonds, but are focused on supporting low emissions technologies or resource management projects. Okay, so how do bonds work? Let's use an example of a clean energy project. A developer may sell 3 bonds for, say, $100,000 each to one or more investors in order to finance a solar PV project. In return, the developer agrees to not only pay back each investor in 10, 20 or 30 years' time, but also pay annual interest on each bond for the duration of the bond's life. The main difference between a bond and a loan is that a bond can be traded on the market. Its final market value is payable to the investor and may go up or down due to exchange rates, interest rates or other factors. So, what is the potential for using climate bonds to address the direct climate finance shortfall? Well, the UK-based Climate Bond Initiative estimated the fast-growing climate bond market to be worth around $41 billion in 2015 and suggests that a target of $100 billion is possible in 2016. Direct climate finance is important to driving early-stage innovation in new, low-emissions technologies. Direct climate finance has played a key role in pushing down the cost of wind and solar power to a point where they are now competitive with fossil fuels. Direct climate finance comes from both public and private donors. These range from government agencies, investment banks, pension funds and charitable foundations to wealthy individuals and private companies. Currently, around 93% of this funding goes to climate change mitigation, with renewable energy, energy efficiency and sustainable transport the most commonly supported projects. Around only 7% of direct climate finance is currently being directed to climate change adaptation. When we talk about the risks and opportunities of climate change, direct climate finance represents a big opportunity for business and communities. This is especially true in developing countries, where the majority of climate finance initiatives are focused. By understanding how this type of policy works and the potential funding available, you're better equipped to leverage direct climate finance.